Hello, Money Show viewers. I'm Kate Stalter here at the Money Show San Francisco. So happy to be joined today by Bruce Johnstone of Fidelity. And Bruce, you're about to give a talk here in a little while, really keying in on maybe the economy and the markets since the election. And I know a whole lot of people expected maybe that the rally might tank at that time, but the rally that we've been seeing since 2009 remains underway for the most part.
Correct.
Talk to me a little bit about what you're seeing in the landscape right now and how politics might be affecting things.
Well, it is interesting, and Ed Yardeni, by the way, is going to cover the Trump administration and politics in greater detail than I am. But let's not kid ourselves. Politics are an event that are intruding into both the economy and the markets. And so what a lot of people assumed that when Trump was elected, the markets were going to tank. But what everybody did not take into account is that there is an optimism that has arisen because of the way he tried to get elected, of what he has promised in terms of economic improvement, and so what is going on is that business confidence has improved. Consumer confidence has improved. He has talked about deregulation, and in fact, that is where he has made dramatic strides, because the number of new regulations in the first 6 months of his administration has been the lowest we have seen ever since they took measurements of this kind of stuff. So there is an optimism. Obviously, a lot of people are concerned about his twittering and the volatility of his back and forth. He was not successful about getting health care repealed, and he was not successful yet about getting tax reform. But what people are not taking into account is that there's a lot of soft data that say that the economy does have a chance of improving. Mm-hmm. And the market, as you know, has dramatically improved since the election, notwithstanding all of the disagreements and the complaints. So my feeling is that it is, I'm not saying we're going to have rocketry in terms of economic improvement, mm-hmm. But what I am saying is that there is a chance for economic improvement, and the market's like that.
What should the individual investor do with this information? Because as we know, markets are unpredictable. Market rallies and market corrections can really happen at almost any time. What's the message here for the individual?
It's very difficult, to be honest with you, Kate, because the economic improvement that I alluded to, other than deregulation, has not yet taken place. So that's one factor. And the second factor is that, let's not kid ourselves, stocks have had a good run, mm-hmm. and they're not cheap. So what I do is I look at three pillars underneath a decent stock market. I look at corporate profit growth, I look at inflation, interest rates, and the adequacy of liquidity, and I look at valuations. Mm-hmm. And corporate profit growth, I think, is As I said, it's okay. It has a chance to get a little better than it has been because it's been very sluggish in the last 8 years. Inflation, interest rates, and liquidity, that particular support underneath the market seems to be okay right now. The third pillar, valuations, a little dicey. A little dicey. There's no question about it. The stock market is selling at prices that we haven't seen in, well, almost never really, as a measure of market capitalization versus GDP. So from that point of view, so what I say to investors is, look, the Dow is up from 18,000, almost 19,000 to 22,000 since Trump was elected. And so you can't expect that we're going to see a tremendous rush in market appreciation. But my message is steady as she goes. That's my message. That in the long run, we got a great country, we got a great economy, that I think, notwithstanding the D.C. paralysis, all of the confrontations that have gone on, that are going to go on, I think that corporate profit growth, the inflation interest rate background, and valuations, even though valuations are a little extended, mean that you're very likely to make a 3 to 5% appreciation in stocks over the years for as long as the eye can see. So I'm okay with that situation. I'm not wildly bullish, but on the other hand, I think you can't be discouraged because there are a lot of things that can be done to improve the economy, which underlies, of course, the stock market.
And it's so easy to get scared by some of the day-to-day, and I think your message is focus on the long term, not just the noise we see in the news every day.
Yeah, because as I'm going to talk about in my talk shortly, in my presentation shortly, the short-term arrangements that you just alluded to, Kate, you can always have hiccups. I actually have a slide that depicts hiccups. And stock markets can go from being slightly overvalued to slightly undervalued. But in the long run, I am a 3 to 5% improvement kind of a guy. You add in a couple of percentage points of dividends, that's not bad. It is not necessarily what we're used to in terms of, we were used to what, making 9, 10, 10.5% per year.
Right.
I don't think, from a demographic point of view, I don't think we're ever going to get back to that kind of situation. What people tend to forget is that from a demographic point of view, after World War II, population growth in the United States was 2% a year. Well, we're not going to ever get back to 2% a year.
That's true.
So if demographics say, oh, gee, well, maybe population growth is going to be 0.3, 0.4%, how in the world can we go back to the old growth rates?
Right.
It ain't going to happen.
No, that's exactly right. So one of the messages here, manage your expectations, understand what's really going on.
Yes.
I want to thank our guest today, Bruce Johnstone from Fidelity. Some great advice here, and thanks everybody for watching.
Thank you, Kate.